Hello and welcome to the Reorg, where we are diving deep into the S&I archives and re-examining old ideas after many years of accumulated proof of work. This is your host, Michael Goldstein, and today we are continuing our journey through the S&I mempool crash course in Bitcoin political economy, where we set out a vision over a decade ago of why we believed Bitcoin would outcompete fiat and precious metals to become the next world reserve currency. Our next article is one called The Bitcoin Central Bank's Perfect Monetary Policy, written in December 15th, 2013, when the price was about $865. And joining us today is the author of this wonderful article, Pierre Rochard. Pierre, how are you doing?
I'm doing very well. Thanks for having me back. I'm excited to go through this one.
So this one is it's a very good article. We'll get into it, but I want to give a little backstory to it. And also note that this is I would say a highly influential but very underappreciated article that's on our website. And the reason I say that is I might be remembering completely wrong, but I think that Saifedean Ammous once told me that this article was a major inspiration for the Bitcoin Standard, with the Bitcoin Standard almost being like a full book treatment of what this is. And I would go even farther and say that the fiat standard is also effectively a kind of downstream of this way of thinking about Bitcoin. So great to keep in mind as we go through this. I'd like to start, like I said, with the backstory, which was an article written, if I remember correctly, this was effectively what you were responding to back in 2013. So this was an article written for The Atlantic, November 21st, 2013. Price was roughly around that 865 range. This was when Bitcoin was hitting 1,000 for the first time. And Matthew O'Brien had this to say. He said that Bitcoin is the Segway of currency. And the idea here was that you have this thing, the Segway had been a majorly hyped technology, but then it actually arrived. People saw what it was, and it kind of had its niche with maybe the Paul Blart mall cops of the world, but otherwise was kind of a dud and a bit of a joke. And so he was viewing Bitcoin as sort of this underwhelming introduction of technology into the money as a solution to monetary issues. And his arguments for it are pretty standard arguments around money. And you can see what he sort of sees as just this crazy hype, and to him it's just a Ponzi. And he goes on and on about all the different stuff that at this point we're very used to hearing, but he was trying to make these arguments, and you effectively saw this. So funny enough, his handle is Obsolete Dogma, which I think is very fitting for his way of thinking about money here. But your approach to responding to him today, a lot of people enjoy being toxic and start doing the have fun staying poor and kind of laughing at them. But you took a different approach, I think, especially coming from your debate background of wanting to take these ideas head on. And so the way that you did it was writing this article, The Bitcoin Central Bank's Perfect Monetary Policy, in which you basically decided to treat Bitcoin, the Bitcoin network, as if it was a central bank, and describe its operations in that terminology, so that we can have that as a basis to have a real discussion about the pros and cons of the current system as well as the Bitcoin system, and not looking at it merely through these sort of tech hype cycles and kind of fervent animal spirits that a lot of skeptics wanted to look at because of the crazy price. Is there anything else you remember about what motivated this?
No, I think you covered it pretty well. I would note that I see kids on devices that are very similar to the Segway just zoom by on the sidewalk in front of my house pretty often. So I guess it was probably not, hindsight 2020. People continue to use these electronic devices to transport themselves. But putting that aside, I still think that and it's still something that I bring up when people today talk about the difficulty of understanding Bitcoin and understanding its valuation or its taxonomy. How do we categorize this? Well, it's a currency. You can think of the Bitcoin network like a central bank, and then you go from there in terms of analyzing what its economics are. So yeah, definitely a timeless piece.
Excellent. Well, let's get started. The following post provides an analytical framework so that critics and proponents of Bitcoin's monetary policy can engage in constructive debate. Bitcoin has a central bank called the, quote, Bitcoin Network, which we will refer to as the Bitcoin Central Bank, or BCB. This central bank issues a currency called Bitcoins and processes the transfer of Bitcoins between accounts. The BCB's rule-based monetary policy was set at its creation, and its independence is secured by the distributed nature of the underlying network. This non-discretionary monetary policy can best be described as asymptotic money supply targeting. And here you share a labeled graph that's just like the one that we saw in End the Fed, just showing the money supply, the total money supply versus the growth rate, and just how rock solid and a perfect geometric series that it is. And you go on to say, the BCB issues Bitcoins to a network of subcontractors called miners who perform the proof-of-work calculations that secure the BCB's independence and process payments. The seigniorage subsidizes the payment system instead of benefiting the issuer or the seller recipient of bonds transacted in open market operations. Proof-of-work seigniorage, POWS, and AMST work synergistically to cause three monetary phenomena. 1. Rational economic agents hold a balance of Bitcoins even if they have no Bitcoin-denominated liabilities. 2. The market sets exchange rates and interest rates without exception. 3. Fractional reserve banking cannot develop, so liquidity traps are impossible. So I'd like to go through each of these and discuss, we'll read through what you have to say about these phenomenon, and then also talk about what is the default, shall we say, Keynesian view of how these phenomena should be handled by a central bank versus how Bitcoin does, and why we believe Bitcoin is the superior choice. So, first, it is rational for economic agents to hold as many Bitcoins as they can afford to lose, i.e., without materially impairing their ability to consume or invest. The BCB can offer lower transaction costs than any competitor by orders of magnitude because of the POWS subsidy. This deep competitive advantage gives economic agents the expectation that it will be adopted as a method of payment and that its exchange rate liquidity will increase. This expectation has repeatedly proven to be true, so the desire to hold Bitcoins has increased, as indicated by the exchange rate and internet search volume. And then we see the table that we also saw in End the Fed, Hoard Bitcoins, that goes through the different transaction costs that Bitcoin faces and or money in general face, and how they compare. One thing I will note is I think that it's interesting that at the time there was an expectation that we would see a sort of a growth in Bitcoin as a method of payment, but I think we would both agree that was not exactly the actual path in which it took. There was more of a focus on the actual hoarding aspect and liquidity growing from that because of the growing exchange rate.
Yeah, I'd say, if I go back and look at this 2020, it definitely got some things Incorrect. I mean, I think that if we go back to that previous paragraph about how, the miners are subcontractors, I think that's right. I borrowed the view that Satoshi expresses in his white paper that the new issuance of Bitcoin is helping bootstrap the network of nodes. That is, that if you want to mine, you have to run a node at the time, although it's not strictly necessary. We've got people doing headers first mining at some point in Bitcoin's history. That did not end well. So the bootstrapping mechanism for the network of nodes, I think that's a valid point that's the direction of what Bitcoin mining does at the beginning. It was still early days, and so I hadn't really connected my thoughts on the energy consumption and the fact that Bitcoin mining is actually destroying the seigniorage. And so I think that if you look at it back then, the profit margins for mining was probably greater than it is today if you look at it from an energy perspective. And so it certainly during the early days of Bitcoin, you were, it was this circular relationship between people thinking about, okay, what's the cost of mining Bitcoin on my desktop Pentium 4? That will determine how much I'd be willing to sell it for in the market. And so that's how I think Bitcoin bootstrapped its initial dollar value. But, there's a lot more to be written on this topic, because now it's clear that the Bitcoin mining subsidy, the new Bitcoin being issued, is not actually subsidizing your ability to send payments. The ability to send payments was actually very inexpensive for a completely different reason, which is that it only becomes expensive when it's a matter of congestion control to keep the Bitcoin network decentralized. So, I think that I could have made the point that payments are cheap, even if transaction fees are volatile. And then obviously since then we've got the Lightning Network, this was written before the white paper for the Lightning Network. So basically I think that today I'd say that payments are cheap, full stop. And the reason why they're cheap is because of the subcontractor part. Whether it's for a Lightning routing node or for a Bitcoin miner that's including transactions on a block, they do not have a natural monopoly on what can go through the network. They're actually competing against each other within the framework of the network, which is there was a really great academic paper written on this topic, contrasting it with Visa and MasterCard, for example. And in fact, there's politicians that want to try to force Visa and MasterCard to essentially adopt Bitcoin's model to drive down their profit margins and make fiat payments cheaper. So, I think that there's definitely edits that I could make here to make it more accurate, and that I had an incomplete understanding of what the economics of the payment system were at that time. But the end result, the cheap payments part, I think still holds very true, even though obviously there's been periods of volatility with transaction fees.
Yes. Regarding the seigniorage, when we look at the chart of the money supply targeting and the total money supply and the growth rate, we were only a little bit past the first halving. And so in many ways, there was much more of a seigniorage, like you were saying. There was much more, probably much more profitability. But it was also, it still felt very like we were only a little bit into the game of mining the Bitcoin, because there was only a little bit more than half of all Bitcoin mined, which obviously is the first half was done so quickly. So it still felt very new, whereas like now we are much farther into this. We have over 91% of Bitcoin mined. So a lot of that has gone away. And the block reward is a little bit different than kind of we were thinking about at the time. On this, though, so the idea of rational economic agents holding a balance of Bitcoins, even if they have no Bitcoin denominated liabilities, how does this compare to the sort of Keynesian model of central banking and how we would view, say, dollar holding?
Yeah, so I'd say that in the Keynesian model, it's that you're going to have to pay taxes in the future, and so that's why you have to hold dollars. And so you have a dollar-denominated liability built into the system, and that, from contrasting it with, so here I would add something that I didn't emphasize enough at the time, which was essentially about minimizing uncertainty. And so the reason why it's rational to hold some Bitcoin, even if you don't have Bitcoin denominated liabilities, is because it's the least uncertain monetary system in existence. And that to benefit from that uncertainty minimization, you don't even have to look at the permissionless nature of transactions, the censorship resistance, although those are obviously half of the equation. The other half of the equation is that you can actually hold Bitcoin on your own keys and be, self-sovereign in that regard and not have to worry about your Bitcoin being seized or anything like that. And so I think that would double the value of this paragraph if I added something about the self-custody aspect of Bitcoin.
Right. So, I mean, in the Keynesian world, there's an expectation that you're really not going to be holding a lot of dollars. It's meant to be. There's also talk of velocity of money and the circular flow. And so you want that money to be moving, and you don't really want it to be sitting in a cash balance. That's seen as the productivity coming to a halt. And I think this plays into the next one a bit more. So I think we should read that, and then we can go back to this.
Well, I just want to add that for the Keynesians, they have the luxury of not really having to think about this question very much, because they are essentially abusing the fact that all of these network effects are holdovers from the era of being backed by gold. And so they can just abuse the users of dollars and not think too much about whether it's rational to hold dollars or not.
Right. Yeah. Like we said last time, a lot of people, they put money in a bank literally thinking that it's just money sitting there in a bank. Like there's a big gold vault. There's the CEO of the bank comes in like Scrooge McDuck every morning to go jump in the gold coins. But that's not really how the banking system works. So we'll move on to the second one, which is the market sets exchange rates and interest rates. The exchange rate volatility is a byproduct of the BCB choosing independent monetary policy, AMST, and free flow capital over a fixed exchange rate within the Impossible Trinity. Economic agents overcome their cognitive biases to acquire bitcoins in waves due to the word-of-mouth marketing of the currency. For some, it takes one exposure to Bitcoin to, quote, get it, while others follow the lead of trendsetters or finally succumb to their regret aversion bias. Either way, these waves of adopters have a destabilizing effect on the exchange rate. Speculators are unsure of the amplitude or wavelength of adoption, and amateurish punters let their excitement as well as subsequent fear overwhelm them. The BCB does not intervene to stabilize these intermittent hype cycles because steady appreciation of the exchange rate would allow for an even greater buildup of speculative excesses, and the BCB would lose confidence that AMST gives to long-term holders of Bitcoin. Bitcoin's interest rates are based on the arbitrage between the expected return of holding Bitcoins versus the expected return of lending them out. The expected return of holding Bitcoins is completely tied to its expected future exchange rate because Bitcoins are currently a pure vehicle currency. The heterogeneous expectations of Bitcoin holders regarding the exchange rate has led to the development of marginal lending operations. However, the vast majority of Bitcoin holders expect exchange rate appreciation at rates far greater than any borrower is willing to pay. Bitcoins will continue to be hoarded, and Bitcoin-denominated credit markets will continue to be underdeveloped until either the expectations of Bitcoin holders adjust downward or are met. The BCB does not need to take action to break the current equilibrium state, since the hoarders' expectations will be met given Bitcoin's proven superiority to legacy payment networks and stores of value. And then we have that the graph showing hoarding as a main driver of adoption, which maybe we'll get to again. But regarding all this, so Yeah. So in the Keynesian model, what I was going to say before was that not only they don't expect you to hold dollars, and they want dollars to be moving. So in fact, they purposefully use monetary policy to push you towards a particular investment rate that they think is the correct one. And so they want to control these numbers and pull these levers on the economy, whereas you're explaining how Bitcoin is sort of just set in stone.
Yeah, that's right. And so with Bitcoin, you have this free floating exchange rate, or sorry, exchange rate and interest rate. With dollars, they target the interest rate, and then that has a knock-on effect of the supply of money and the exchange rate of dollars, i.e., the consumer price inflation or even the foreign exchange rate. So I think that this is the part where people can't understand or wrap their minds around the fact that Bitcoin's so volatile. It has to be volatile in order to be able to have this kind of monetary policy. The only time in the dollar's history that I know of that had money supply targeting was under Paul Volcker, when he was fighting inflation back at the end of the 70s and the beginning of the 80s. So it is considered by mainstream economists to be the most restrictive form of monetary policy you can have, of targeting the money supply and letting the interest rate just go wherever it needs to go in order to achieve that particular money supply. And so that's why interest rates went up to 20% under Paul Volcker. And I think that we still don't have Bitcoin denominated credit markets. And I think, we should expect them to continue to not develop. There was an attempt to do it in the last cycle, and those folks
worked out so well.
Yeah, they got wrecked hardcore. What we do have, though, is obviously dollar-denominated credit markets that lend using Bitcoin as collateral rather than using Bitcoin as the unit of account, which makes a ton of sense. So the other part that is really key, I think, here that could definitely be expanded upon is the concept of a vehicle currency. This is a concept that I learned from our friend Paul Krugman, where basically
you've learned many great things from Paul Krugman.
Yeah, he used to be a real economist, but he also, yeah. Anyway, so The vehicle currency concept, as you can imagine, is where on one side you might be selling dollars to buy Bitcoin, and then on the other end you're selling Bitcoin to buy dollars. And so you're earning your income in dollars and you're spending at the supermarket in dollars, but the vehicle in between is Bitcoin. And the distance you're traveling is over time. So this is really, I think, what people miss when they talk about, oh, nobody's using Bitcoin for payments. Well, yeah, they are. They're just not doing it in the way that you want them to do it, which is directly. They're doing it via a vehicle currency. And I think that offends some folks who, when they read the Bitcoin white paper title of peer-to-peer electronic cash, they feel like, okay, in order for it to be peer-to-peer, I have to make sure that it's a tight circular economy. It can't be an indirect circular economy.
This is also something that even Austrians get tripped up on, specifically with regards to Bitcoin, because they think that Bitcoin as money, in developing as money, I should say, so the actual process of monetization necessarily needs to have a certain level of Bitcoin being used as the direct method of payment between consumers and businesses and so on, in order to be going through that monetization process. Whereas I think we would argue that, well, reservation demand is a huge part of a money's value. And so actually the growing reservation demand itself is indicative of monetization, even if the specific use of it as a method of payment is lacking. And in the Austrian lingo, if you were to open human action, what you would want to look for in terms of I actually am not familiar with Paul Krugman's vehicle currency writing, so it might be a little different, but based on how you're describing it, what you would find is a discussion of what Mises calls a secondary medium of exchange. So traditionally, if we say there's gold as the sort of primary medium of exchange, the money, you would have secondary media of exchange. He points to jewels as being a very common example of this. And I think as frankly, as the money breaks down, you get more and more of these, whether it's like art, real estate, or whatever it might be, that sort of gets a monetary premium. But basically, these secondary media of exchange, they have any media of exchange, even if it's not the number one media of exchange, insofar as it has value because it is overcoming some uncertainty that we were speaking of. So if one of those is, for instance, a sort of uncertainty about the value of the good going into the future, even something that is not what is being used to go buy things at the store, like dollars, might be used as a, quote, store of value because it's able to overcome that uncertainty. And I think that's what Bitcoin is. So like a vehicle currency, it's a secondary media of exchange because it's able to take on so many of the uncertainties that money is trying to deal with, but it just hasn't fully gotten a network effect that's large enough to make it more liquid than the primary money. And so a lot of these debates, people go all bananas over these defining money, whereas I would say that the concept of money, like the term, it's very nebulous, and Mises and Rothbard would agree with this, that it is sort of the job of the historian to determine what the money was in a society, but the actual theory applies to all media of exchange. And yeah, you can have these other media of exchange insofar as the primary one is unable to deal with some uncertainty. The cost of the benefits of having the secondary media of exchange, if they are greater than the costs of holding the money, you would expect it to develop. And that's exactly like you said, what Bitcoin is doing with the lending operations. Yeah, I mean, to really drive this home, I remember how many questions I was having to field about, should I use BlockFi? Should I use one of these companies? And you look at it and they were giving what? I think it was like 5 or 6% or something like that. Yeah. So that's effectively, that's the interest rate that the borrowers are willing to pay. And it's absolutely absurd because not only is it you're dealing with a situation where Bitcoin might be going up as much as, say, 10x, which at that point you're picking up pennies in front of a steamroller. But then it's even worse because you're dealing with a lending market where the people you're lending to, there's the classic question from Alan Farrington of, where does the yield come from? What is the actual yield? It's like, well, they're taking the Bitcoin and what they're investing in, they're not investing in some new cool business and building new appliances and tools and consumer goods and things that people actually want and need. They're using those Bitcoins to go play gambling games on various altcoin casinos. So there's not really a real business there, and that comes with all kinds of, like, any lending is risky. You never know if you're really going to get your loan back. But when they're taking it to the casino, you have way less expectation of that actually coming back. So not only are you chasing pennies in front of a steamroller, but it's the pennies might not even be there. The principal might not even be there. And in fact, for a lot of people, it wasn't. So it just is not worth it. It's so much easier. And the sort of long-term expected value of everything works out. It's just literally stay humble and stack sets is just a better strategy in such an environment. Last thing. Sorry, did you have something?
Oh, no, I was just going to add there's no bailouts. But yeah, go on to the last thing.
Well, so on this section, I just wanted to point out the what you referred to, the Impossible Trinity, and sort of discuss how Bitcoin fits into this. So I forget the name of the economist who developed this, but basically the idea that you have three choices and you can choose two. So you can't have all three of these concepts: free capital flow, fixed exchange rate, and sovereign monetary policy. You can't have all three. So you have to choose which two you want to go with and stick with it. And I think the broad Austrian view is more of choosing effectively what Bitcoin chose, which is the B in this triangle. So free capital flow and sovereign monetary policy. Whereas a lot of the ways that people think about money, they're much more interested in the fixed exchange rate, which is necessarily going to come at the cost of free capital flow or sovereign monetary policy. The only thing I would say is, in some sense, the funny thing is with the Bitcoin monetary policy, it's like sovereign beyond sovereign, in the sense that you can run a node and you can even state whatever monetary policy you want on your node, but you are still succumbing to what is the actual sort of network consensus. So there's the network governance of that sovereign monetary policy. So it's, in some sense, it's more in this, I almost think of it as just the free capital flow, but there is a sovereign monetary policy. It's just, it is so sovereign that it's outside any particular human sovereign.
Yeah, that's right. And something that's interesting to think about too is, if the dollar wanted to have a fixed exchange rate versus Bitcoin, it would have to sacrifice its independent monetary policy or the free capital flow with Bitcoin and implement capital controls. So I think that, if we look back at what Operation Choke Point 2.0 and SAW 121 and all of these regulatory things under Biden, where they were hampering the free capital flow because Biden wanted to fix the exchange rate with Bitcoin at a low price, right? They were trying to suppress the price. Obviously, that doesn't work if you have a global network, because then, he's just competing with other foreign powers. But the other piece of it, I think, is that the fixed exchange rate, you can achieve a fixed exchange rate with Bitcoin by using futures contracts. So you can lock in a fixed rate on Bitcoin by selling a futures contract on CME, for example, or even by doing it with some kind of discrete log contract with an oracle. And that way you know for sure the dollar value of the Bitcoin, will be at a certain point in the future. But that comes with costs. So that's something that you have to pay for in order to achieve. With fiat, they give you the fixed exchange rate, and it seems like it's free. And they do the same thing, for example, like with credit cards, right? So it seems like using your credit card is free, but that's only because the merchant is paying the 3% fee on their end.
Which also means you're paying it.
Yeah, exactly. Indirectly. It's a hidden tax. And it's the same for the fixed exchange rate. It's a hidden tax. And who benefits from it? Well, of course, the politicians and the bankers, who are the ones printing the money in order to fix the exchange rate.
Yes, and having that free floating rate, I think, it's very important within the realm of money. Obviously, it's sort of an unpopular position for many reasons, but I think some future articles get into this specifically. But there's no true stability in the economy. Everything is always uncertain in the future, and that's why we hold money at all. And so when you're trying to have too fixed of an exchange rate, you make that the sort of pinnacle of your goals. You are in many ways trying to go up against reality. And in order for money to work properly, I would argue that it needs to be able to have a free floating aspect so that it responds to people's actual needs based on their real perceptions of uncertainty in the economy.
That's right. It also throws a wrench in the idea among Bitcoiners that once we get to 100% adoption, that Bitcoin's purchasing power will be stable. And I can certainly concede the argument that it will be less volatile than it was in the past when we had rapid phases of adoption. But I still don't think that it's going to be as stable as some might imagine of just tracking the productivity of the economy, for example. I still think that there's going to be not just structural adjustments in the economy that cause the Bitcoin purchasing power to change, but also panics of everybody trying to hold Bitcoin at the same time. I think that's going to continue to happen, and that see it, for example, in like the Bitcoin denominated price of the stock market. You'll still see more volatility in that than you will have seen with the dollar denominated price of the stock market.
Yes, well, you can have like what Bitcoin gets rid of. We're going to talk about fractional reserve banking again next, but what it gets rid of is not the entire concept of an entrepreneurial boom and bust, where there's entrepreneurs trying something out. Maybe there's some kind of fad. There's like an idea, a hype cycle around a new technology, and there's what we know about hype cycles there. It doesn't get rid of that. It only gets rid of the systemic economic cycles where it's dealing with the base money and the fraud underneath that drives that. But you can still have these situations where people have a series of entrepreneurial errors where they believe that there's something to the new thing, and it turns out to not be so great. If you were basing your economic outlook on like Betamax, when it's Betamax versus VHS, you could have really powered in money. You may have even made some profits in the short term, and then the market as a whole realizes it's like, oh no, we're actually going with VHS. And so all of the sort of entrepreneurial energy, so to speak, that went into Betamax dissipates. And so locally, there is a sort of boom and bust. It's just not a systemic thing. And it's not based on any kind of fraud or basically malicious behavior on one side or another. It was just a false, it was an entrepreneurial error. So they made a guess and it was wrong, and they move on, and it actually sort of teaches you something about the economy and helps you hopefully have a better understanding of what to do. And yeah, I think that's important to understand, is there's still going to be volatility in the economy. There's still the economy is an extremely dynamic thing, and that's exactly why you want it to have a free floating nature, because you want the money to be able to go with that ebb and flow. And yes, if there's a situation where the economy as a whole is having a bunch of entrepreneurial errors, you can end up with a situation where people are chasing after cash and the price goes way up. You could also have the opposite, where it's like the economy is doing so well and people are so locked into exactly what people need that the demand for cash diminishes because exactly where that money ought to go, and you are getting the returns you desire from that. And I think the people are aware of Michael Saylor's view that inflation is a vector. So it's something that is based on a person's particular needs. So inflation does not hit someone who's just living in their parents' basement eating fiat food quite in the same way as the person who is trying to acquire Manhattan real estate. It is highly dependent on the individual. There's no one true inflation number. And I would likewise say that the corollary to that is the other side. There's no one true economic growth number. There's not like a true like the economy grew 5% this year. It is highly dependent on, well, what specifically did you want in the economy and how much cheaper did it get that year? So it's very possible that it was actually getting more expensive for you because your desires were becoming a little more maybe luxurious, or you have bigger demands of the world. And so we don't have these one true numbers to work off. And so this also plays into, and is also defined by, but the dynamic nature of the economy. And I think that's something that the Austrians are very good on, is taking very seriously the dynamic nature of the economy, how economic development is a process, and you have time, and you have heterogeneous capital. So you don't have everything it's not just one big blob we call the economy. Every factory does very particular things, and you can't just switch them from one thing to another. And if you turn them off, they don't just turn right back on again, unless it's a Bitcoin miner. These things all need to be taken into account, and having a free floating money is the best way to coordinate through all of these different ebbs and flows of people's preferences and such. So moving on to the last section of this. Oh, I guess as an aside, this chart, this graph, we talked about it last time, and we kind of pointed out flaws in how there's kind of the understanding of how the adoption goes, where this graph really doesn't hold up quite in the way that we may have thought it would. I think is, as an aside, it's a good lesson that any meme that you have is always going to be some lower resolution of the truth, insofar as there's truth in it. And so that means that it's never going to capture everything, and thus there's an ebb and flow to memes. And as the truth changes, maybe that means that there's things about the meme that are actually wrong. But there's also ways in which the way that we would describe things changes over time. I see a lot of people in the Bitcoin world, they get frustrated because memes feel like they start to run dry, because it's like you've heard the same thing over and over. And what that really is for that person, there's an itch for trying to find something deeper. But there's also other people haven't heard these memes, and they might still carry value in that. And so I just think it's interesting how these things play over time, and how even the idea of educating is a very dynamic process. And as we're pointing out here, there are things in this article that they're actually in many ways completely right, but it's like, well, now we know more, and it would have been better to have some additional context, which is why we're doing this podcast. So finally, on to the last one, mirroring what we talked about last time. Fractional reserve banking cannot develop. Fractional reserve banking entails the creation of new money that is fungible with already pre-existing money, i.e., it can be used interchangeably within the currency's payment systems. This is impossible with Bitcoin. The BCB enforces the strictest deposit regulations in the world by requiring full reserves for all accounts. This is the digital equivalent of the Chicago Plan or the Austrian 100% reserve gold standard. Under this regulatory regime, money is not destroyed when bank debts are repaid, so increased money hoarding does not cause liquidity traps. Instead, it increases real interest rates and lowers consumer prices. This is a self-stabilizing cycle, as higher interest rates incentivize hoarders to invest, while deflation increases consumption due to the wealth effect on hoarders. The BCB prevents lending out of deposits so that it can properly target money supply and avoid the destabilizing effects of commingling the credit and payment systems. The positive properties of AMST and POWS combined make it certain that, absent a technological problem, Bitcoin will be adopted as the global currency. For a deeper understanding of the market process involved in becoming global currency, I would recommend reading Conrad Graff's explanation of hypermonetization and Peter Serda's liquidity analysis of Bitcoins. The Bitcoin central bank will be the longest lasting institution of its kind, thanks to the anti-fragile independent monetary policy it has set in stone. So once again, we're pointing out, we kind of touched on this just now, but all the ways in which Bitcoin just does not engage in the expansion of credit in response to the changes in the economy. Could you talk a little bit about liquidity traps and why that is so feared? And we can bring it back to how Bitcoin is in fact self-stabilizing.
Yeah, so in the fiat fractional reserve banking system, and even in fractional reserve with dollar or gold backed, gold standard fiat. I'll just put it that way. When banks lend out money, they actually create it out of thin air, and that way they are able to expand the money supply in accordance to the demand for money in the economy and the demand for credit in the economy. So this causes a lot of problems because essentially, if you are in a situation where you have an economic slowdown and you have people defaulting on their debt, it would be one thing if when they default on their debt, it's just whoever lent out that money incurs a loss. But it's another thing if when they default on their debt, that means that the bank essentially becomes insolvent, and then they have a bank run and everybody's trying to get their money out of the bank. And at that point, you have simultaneously a collapse of both the credit system and the payment system. So this is what happened with the Great Depression. And it's funny, there was a speech that Ben Bernanke gave when he was an academic / a Fed affiliated academic. And there was Milton Friedman in the audience. And Milton Friedman wrote a book about how essentially the problem with the Great Depression is that the Fed did not bail out the banking system. And he's correct in the sense that when you have a fractional reserve banking system, the central bank exists to bail it out. And if it doesn't fulfill that function, then you get into a downward spiral of deflation, causing further destruction of credit, causing further deflation. And so it's something that is very disruptive to the economy, and that you need the central bank to come in and bail out fractional reserve banking. Now, obviously, it would be much better if you just didn't have fractional reserve banking to begin with. So then, you're not in a situation where you have to bail it out. But putting that aside, Ben Bernanke told Milton Friedman, we will not make that mistake again. Lesson learned, we're not going to fail to bail out the banks. And sure enough, fast forward to 2008, 2009, Ben Bernanke made good on that promise to Milton Friedman, and he aggressively bailed out the financial system to prevent that kind of spiraling downwards of deflation. And it's a bad kind of deflation in the sense that when Austrian economists speak of deflation being good, what they're talking about is when the purchasing power of the currency is increasing because the productivity of the economy is increasing. If you have a scenario where by government policy they are destroying money, that's a bad kind of deflation. It's just as destructive as inflation from increasing the money supply. It is. So in any case, that's basically the liquidity trap.
Well, I would say, by the way, that when Austrians say deflation is good, so for instance, Guido Holzmann's Deflation Liberty, he's also meaning deflation just in the sense of the bust of an economic cycle, unwinding bad malinvestment. That deflation is occurring for what we were saying earlier, which is there's more uncertainty in the economy. And so people are running to money. And that's a good thing because you're liquidating all of the bad investments so that the economy can get rid of all of those things that weren't really supposed to be there and more quickly get back on track to sort of the, quote, natural economy. And so there's that. But what you're saying is this is a situation where they're literally destroying the money. So it's purposeful deflation as opposed to the economy sort of naturally trying to heal itself.
Well, that's right. And that you actually, in this situation where you have a fractional reserve banking system, you cannot specifically target the malinvestment for liquidation. Everything gets liquidated, including good investments. And so that's where it really becomes destructive, and there's no other way around it. And so I think that's the challenge of this idea that we'll have free banking where only bad malinvestments will get liquidated and the rest of the economy will be just fine. What ends up happening is because all of these things are bundled together, they all sync together. And you can't have the targeted kind of readjustments of the economy that you would want if you're kind of, let's say, a Austrian central planner. And so you have to fix the root cause of it. It's so that going forward, you can have liquidations that, as you were talking about earlier, of specific, entrepreneurial activities that don't work out without having a systemic problem, which is what this liquidity trap is. So the Austrian solution is just 100% reserve gold standard, or just, specie standard, which is great. But politically seems to, have not gotten a lot of traction. The neoclassical solution is called the Chicago Plan. And I think that, if commercial bankers and their lobbyists did not control Washington, D.C., then this would have some kind of chance of actually becoming policy that would be amenable to enough special interest. But the Chicago Plan, and it was actually recently, there was a paper called the Chicago Plan Revisited, which laid out using quantitative methodologies to show that, you can actually separate the credit system from the payment system. You can have a 100% reserve fiat system and do away with fractional reserve banking. And so, and then they showed how this made the economy far more stable because you don't have this problem of liquidations leading to a liquidity trap and needing all these bailouts. And so then, the third point is on Bitcoin, and that Bitcoin solves this without having to have any kind of reforms of the existing system. And it is just de facto a 100% reserve, because you can't take fiduciary media and send a Bitcoin transaction and then expect the other person's node to recognize that UTXO is valid.
Yes. I think to round it out, the way that I would think about this article is effectively with that understanding of uncertainty and the dynamic nature of the economy, and thinking that the reason the Bitcoin central bank has the perfect monetary policy is that the stability it looks for is not in terms of that exchange rate, but in fact, instead in stability in everything else, in the monetary policy itself, the supply of it, the stability in how people hold Bitcoin, that they can know that it's going to be there, and they can know that it's going to be able to go through because of censorship resistance, that they know that the supply is not going to change, so it's not going to get diluted, and that the price is left on itself, and that because it's able to adapt dynamically to people's needs. The way that I would think about it is the way in which Bitcoin miners are, in a sort of local industrial sense, a load balancer to the grid. I think of a monetary policy of this sort as being the economic load balancer, which is when there is suddenly more of a demand for it, it's able to take on that load and just increase the price. And it's able to dynamically adjust to everyone in the market, changing their preferences all the time and working with it. And it's always able to keep that load balanced, where the Bitcoin network, you always have the tick-tock next block. You always know that your keys are working as the way that mathematically they should. But the rest of it, the network is able to take on those changes, and from literally all 8 billion people, they can all be making a decision regarding their preferences to the system, and the perfect money supply is there to balance it all out.
Yeah. That concludes this article. I think that we gave a good retrospective looking back on 10 years.
Yeah, hard to believe it's been that long. I look forward to getting into our next articles, which will deal with proof of work and sort of where the value of Bitcoin came from at the beginning. The Reorg is brought to you by the Satoshi Nakamoto Institute, a 501c3 tax-exempt organizations. So if you are getting value from the Reorg or the Satoshi Nakamoto Institute in general, please consider sharing links with friends, sharing this information around so we can teach more people about these economic concepts, and also consider allowing the wealth effect to wash over you, and share some sats with the Satoshi Nakamoto Institute so that we can help continue this process of educating people on how Bitcoin offers the perfect monetary policy. All right. Thank you so much for joining, Pierre.
Thank you. Have a good one.